Intermarket Analysis. Intermarket analysis is the technique by which different asset classes are analysed with the objective of determining how each one impacts on another. Asset classes have been driven by one another for many years, but it is particularly more significant in the present global market. As a trader, you must accept the importance of keeping an eye on all asset classes and understand how events in one class can have a profound impact on another. The price action of currencies is often driven by their relationships with equities, bonds, and commodities. The performance of a country's stock market can impact its own domestic currency and also that of others. The bond market often enjoys the closest relationship with its respective currency. If a country is heavily dependent on a commodity, changes in its price can have a significant impact on its currency. Let's look at some particular currency correlations. Usually, when the S&P goes up, the dollar-yen goes down, and when the S&P goes down, the Nikkei goes down, and when the Nikkei goes up, the dollar-yen goes down. When bond yields go up, the domestic currency will go up. When oil goes up, the dollar-loonie goes down. When gold goes up, the Aussie and Kiwi against the dollar will go up. When gold goes up, the dollar against the Swissy and loonie will go down. The method of conducting intermarket analysis requires analysing asset classes in relation to a particular currency. In order to analyse different asset classes, we use the following charts: dollar index, S&P 500, VIX, gold, oil, and US Treasury yields. We examine the correlation between these asset classes in relation to a particular currency. Relationships help us view the market as a whole and determine the current risk appetite and market dynamics. No market operates in total isolation to others, and almost all have some degree of linkage. This extends to equities, bonds, and commodities. By knowing what is happening in one market, we can identify opportunities in another.